Welcome back to the deep dive. So you sent over this material on a major airline's Q3 results for 2025, and we're not just treating it like a typical earnings call. We're looking at it more like a blueprint, really, a plan for a pretty big industrial transformation.
Exactly. That's the core of it. The
Mhm.
real goal here is understanding how this airline is trying to, break free from being seen as just a commodity business.
Right, the race to the bottom on price.
Yeah, they're aiming way higher, targeting mid-teens margins even when the economy's shaky. They think they can prove air travel is different now.
So our mission today is to unpack those two big strategies they have. First, winning over brand-loyal customers, and second, using tech for some deep efficiency gains.
And they think these can work together even though that first part means spending serious money.
Okay, so let's start with the Q3 results, kind of the proof point, right?
Yeah, definitely. Adjusted diluted EPS was $2.78. That actually beat the top end of their own guidance range.
Pretty strong.
And looking ahead to Q4 2025, they're forecasting the highest total operating revenue for any single quarter in their entire history.
Wow. Okay, but here's the bit from the CEO that really stood out to me. He basically said the first 9 months of 2025 were tough, an economic downturn for airlines generally.
Hmm.
Yet they expect to be the only major airline to actually grow earnings this year.
And that's the resilience they keep talking about. They're arguing these changes they're making aren't temporary, they're structural.
So they can grow when things are bad.
It suggests that the whole brand strategy is working, acting like a shock absorber. And it promises, potentially huge upside when the economy does pick up eventually.
Okay, let's dig into that first pillar then.
Yeah.
Ditching the commodity idea. If it's not just about price, what are they actually spending on to make customers stick with them?
Well, they're betting big. We're talking over $1 billion a year just on customer product stuff. And they plan to keep spending that billion in 2026, too.
$1 billion a year. That's significant.
And it's not just for the fancy seats up front. That's the crucial part.
Right. They made a point about raising the bar for everyone. Even basic economy customers get things like their app experience, on-time flights, power outlets, seatback screens.
Exactly. And you see it in the fleet refresh. They've put $1.6 billion into getting their signature interior and those screens onto more than half the narrow-body fleet.
How many planes is that?
765 jets, over 146,000 screens installed. Plus, they mentioned spending, 25% more on food this year alone?
Okay, that sounds like a constant drain on capital. But you're saying it feeds into their biggest profit driver.
That's the argument. The loyalty program, mileage plus revenue, was up over 9% compared to last year.
9% is solid growth.
But here's where it gets kind of wild. Their ambition to double the EBITDA from that loyalty program by the end of the decade.
Double it. How? That seems incredibly ambitious.
Yeah, they even said they're still in the pre-game warm-ups for getting its full value.
Okay, but doubling EBITDA, that's not just organic growth. That suggests a massive shift in how they monetize that loyalty base. Is there a risk they push too hard, annoy the very customers they're trying to win?
That's the billion-dollar question, isn't it? The material hints it comes from two main areas. Way more co-brand credit card activity and really maximizing the lifetime value of these super engaged members.
Which brings us back to the product investment.
Exactly. Things like Starlink.
Ah, Starlink. Okay, this feels like a tangible differentiator, something that could actually make that loyalty sticky. They mentioned the first 737-800 it just took off from Newark.
Yeah, and they say this just changes the whole in-flight game. It'll be free for Mileage Plus members, and they want it fleet-wide by 2027.
Free Wi-Fi, that actually works. That is a game changer.
The data from that first flight was pretty eye-opening. 170 devices connected, shooed through 145 gigabytes of data. They said that's about 1,000 times more data than a typical flight uses. You go from just a seat to being properly connected. And the customer satisfaction scores, the NPS, off the charts, apparently.
Okay, I can see how that level of connectivity makes the airline choice much stickier, creates a real advantage. But we have to balance all this spending with the other side, cost control. You don't get to mid-teens margins if costs are exploding.
Absolutely. And this is where we get into a bit of the airline jargon. They reported their CSMX.
Okay, remind us. Cost per available seat mile.
Right. Cost per available seat mile, excluding the really volatile stuff like fuel profit sharing, third-party fees. Their CSMX was actually down 0.9% in Q3.
Down, even with all the investment.
Yeah, down nearly 1%. They're calling it industry-leading.
So why is that small drop such a big deal right now? Especially when, labor costs are rising And they're spending billions on food and screens and Wi-Fi.
Yeah. Well, it matters because of inflation, basically. Their own long-term plan expects core CSMX to go up 1 to 2% a year just from inflation and labor deals. That's even factoring in efficiencies like using bigger planes, what they call gauge.
Okay.
Then they add about another percentage point of cost pressure for all those brand investments we just talked about.
So wait, they're actually targeting cost growth of 2 to 3% a year overall?
Correct. But, and this is the core of their argument, they're confident that this cost increase is completely and more than offset by the extra revenue they get from those loyal customers willing to pay more for the better product.
So it's a deliberate trade-off. Spend money to make more money, fundamentally changing the profit equation.
That's the plan. They believe the revenue outweighs the investment cost pressure.
So what are the specific tech things helping them manage those back-end costs so tightly then?
Well, there are a couple of good examples. First, maintenance.
Sure.
Technicians are using iPads right at the plane now. Means they can instantly pull up manuals, order parts right there. No more walking back to a terminal, fiddling with old systems. It just lets them turn airplanes faster.
And turning planes faster, shaving off minutes here and there, that means more flying, less sitting around, better reliability, lower costs. Makes sense. What about when things go wrong? Weather delays, tech issues?
That's where their IROPS handling comes in, irregular operations. They've got this tool called ORCA, Optimizing Resource Crew and Aircraft.
Or RCA?
Yeah, it uses fancy algorithms, machine learning, the whole deal. It looks at the entire system, planes, crews, customer connections, and figures out the fastest way to recover from a disruption. We're talking minutes instead of hours.
That recovery speed must be a huge factor in the operational performance they reported.
It has to be. They hit some really impressive numbers. Q3 had their lowest cancellation rate for any third quarter ever, and Newark, their big hub there.
Yeah.
Best ever on-time departure performance for a Q3.
That Newark performance is interesting. They linked it to the FAA limiting flights there, didn't they? Capping them at 72 per hour until late 2026.
They did. It sounds like they used those limits to really focus on optimizing the schedule they could run, prioritizing reliability over just jamming in flights.
Quality over quantity paying off.
Seems like it. It supports the idea that a reliable, high-quality experience builds more profit than just maximizing raw departures.
Okay, let's switch gears to revenue and demand. Where are these higher margins actually coming from in the market?
Premium demand is definitely strong. Premium cabin revenue up 6% year over year. But here's the really interesting shift they highlighted.
Go on.
Domestically, within the U.S., they're seeing premium leisure yields. So vacationers paying for better seats often higher than traditional corporate yields.
Hang on. So someone splurging for a family vacation up front might be paying more per mile than the classic business traveler in a suit.
Potentially, yeah. That really flips the old airline playbook, doesn't it?
It absolutely does. What's driving that?
Well, it probably reflects, changing work patterns, maybe demographic shifts, this whole leisure travel thing. But it means the line between business and personal travel profit is getting blurry.
And globally, long haul.
Globally, long-haul corporate travel still brings in the highest yields overall. But that growth in domestic premium leisure, that's a big advantage if your competitors are still totally focused on the old corporate model.
Right. Now, speaking of maximizing revenue, they flagged a problem they keep seeing. Q3 revenue per available seat mile RAFM tends to dip quite a bit compared to Q2 and Q4. They called it an industry issue.
Yeah, RASM is basically how much money they make for each seat they fly, whether it's full or not. And that Q3 dip suggests late summer is kind of a soft spot demand-wise.
So what's their fix for 2026?
It's strategic. They're tweaking the schedule specifically to chase higher RASM, not just fill planes.
Yeah.
They're ending the peak summer schedule a week earlier, cutting some capacity around the July 4th holiday, and running about 15% fewer late-night red-eye flights.
So they're actively trimming the schedule during traditionally busy times to protect margins? That shows some real discipline.
It does, and that discipline is reflected in their balance sheet, too. They got a credit rating upgrade from S&P to BB+ strike.
Which is pretty good for an airline.
Yeah, their highest rating in 2 decades. And their net leverage, debt relative to earnings, is down to 2.1 times. They're getting really close to that investment grade target of below 2x.
And that financial strength is what allows them to keep making these big multi-billion-dollar bets on the customer experience in tech.
Exactly, it's the foundation.
Okay, lastly, we need to touch on external factors. The material brought up 2 big risks they're dealing with. First, the ever-present threat of a government shutdown in the U.S.
Right. They basically said their entire Q4 forecast, that guidance range, was built with that shutdown risk factored in.
Even though things were running smoothly in early October.
Yeah, they mentioned having one of their best operational periods then. Lowest cancellations in a decade, I think. But the planning shows they have to account for that instability. It underlines why that resilience is so important.
Okay, and the second big external issue, Russian overflights. This is a major headache for U.S. airlines, isn't it?
It really is. It puts them at a direct competitive disadvantage. Because U.S. carriers can't fly over Russia, routes like, say, New York to Hong Kong become much longer, burn more fuel.
Well, others can take the shortcut.
Exactly. Chinese airlines, for instance, can still use Russian airspace. It makes their operating costs lower on those key international routes.
So for you, the passenger, that political situation could mean longer flights and maybe different pricing depending on which airline you choose. And the airline is asking the U.S. government
To level the playing field, they're arguing that if there's a ban on U.S. carriers using Russian airspace, that ban should also apply to competitors flying similar routes, including those serving Hong Kong.
Makes sense from their perspective. Apply the rules consistently.
That's their argument, yeah.
Okay, so wrapping up this deep dive, the picture painted by this Q3 2025 material is really one of an airline trying to engineer stability, almost insulate itself from the usual boom and bust cycle.
Right, embedding tech everywhere, from the mechanic's iPad to that ORCA recovery system.
And fundamentally changing the customer relationship through these big investments in loyalty and the product itself, all aiming for those mid-teens margins long-term.
And they see two paths getting them there, hoping the whole industry stays disciplined on capacity, which could add several points to margins.
And their own efforts, their self-help strategy, adding at least one margin point per year through loyalty and efficiency.
Exactly.
Which leaves us with maybe one final provocative thought for you, the listener. The real test of this whole grand strategy might not just be hitting that 1 point per year margin improvement. It might be whether that incredibly bold plan to double the mileage plus loyalty EBITDA by the end of the decade actually comes true.
Yeah, because if they pull that off, it really would prove that the future isn't about commodity pricing anymore. It's about customer data, lifetime value, the strength of that relationship between you and your airline.
That relationship becomes the most valuable asset.
Potentially, yes. That's the bet they're making.